Hello, my friends. Brett Pattison here with Iron Gate Global Advisors, coming at you from the financial capital of the West. That is Salt Lake City, Utah. We've got a lot to discuss today. It is the season to be jolly, and we have had an enormous rally in the market. We're going to discuss that rally in detail, tell you what's happening with sector rotation and a lot of other things. In fact, here's what we're going to discuss. In the next few minutes, we'll give you a market update post-election. And really, what have we learned in November regarding the market? Some important principles, not just what's happening with sector rotation, but important principles that I've seen and continue to see people get completely fried on. And then we'll discuss how December compares with other months. But first off, the market update, just 1 month returns there on your left-hand side. At the very top, you'll see the S&P 500, which is up right around 6% in the last month. You've got a couple sectors that have outperformed. You've got financials up almost 19% and industrials up 11.35%. Those sectors are on fire right now. And is it the good time to buy into those sectors? We'll address that here in a second. You have two sectors that are lagging. That is utilities and consumer staples, the more defensive names. And there's one thing about those two sectors, what those two sectors have in common, that we'll address and talk about why those particular sectors are down over the last month when everything else is up. Let's take a look at year-to-date returns. S&P 500 there at the top, 8.23% return. Energy is killing it. And then you've got a couple lagging sectors as well. As we compare financials 1 month to financials year to date, you can see all of the financials return for the most part it's come in the last month, as has industrials for the most part. It didn't have too bad of a year to date, but certainly most of it has come in the last month. So let's dive into this sector rotation and talk about what we can learn as investors from what has happened. And I've got a graph here, and it's kind of messy, and I'll explain to you what it is so it makes sense. We've got, from a time frame perspective, this is January through about October. And I've selected 5 different things. I've selected consumer staples, right up here, consumer staples. Financials, which is kind of that greenish area. We've got industrials, which is this blue. Utilities, which is the ugly brown color, and then the S&P 500, which is red. And what stands out to me from January to October is that you have utilities, this ugly brown color, really has been leading the market the entire year. And I saw utilities is a dividend-friendly sector. People buy it because they want income. People buy it because they want yield, because it has dividends. That's the same reasons why, for the most part, people buy consumer staples, which has been outperforming the market the entire year as well. So those two sectors leading. And let me set the mode from a psychology standpoint. You have Barron's Magazine for 3 weeks in a row talking about the importance of dividend stocks. You have everybody that I talk to anywhere talk about how much they love dividend stocks. And those two sectors, utilities and consumer staples, are where those dividend-paying stocks are. Brian and I, my partner here at Iron Gate Global Advisors, we often talk about daily we talk about the market, but we have a meeting once a week where we discuss certain sectors. And we have been really fearful for people that are chasing those two sectors for most of the year. And and the reason why is, once everybody is in a sector, once it's on Barron's for 3 weeks in a row, when everybody's talking about a particular sector, that's when you know the ride is over. There's too much euphoria in that area of the market. Time to get out, right? That's kind of the mentality. And you can see for the last month what has happened in the last month. Those two sectors have been hit pretty darn hard, while the two sectors that have really come on are industrials, and financials. So what do we learn from that as we see this huge spike in industrials and financials? Here's what we can learn. We learn the importance of patience. Number one, being patient in those investments that you have. We've been in some financials, and overweight financials, for about a year, maybe a little bit more than a year. And the reason for that is because that's where we found the value. We found some great companies. We found a sector that nobody wants to be in. I've had comments from individuals saying, "What in the world are you in these stocks for?" Because we know that patience works in the market. We also know that we're never going to chase investments. If you see it on the front page of a magazine, maybe not the best investment idea, right? So you've got to find and you've got to buy the value. That's what we've done with financials, and we don't get it right every time. There's some stocks that we are still being patient on because we believe they will pay off in the future. We hope we're right. It's worked out so far looking historically at our returns. But those are three very important principles that we are happy to discuss with anybody at any time. The importance of patience, the importance of not chasing investments, and finding and buying the value, which is the hardest thing to do, which is something that our firm strongly believes in. Those are three things that we discuss in an ebook that we have. If you'd like to pick it up for free, just go to that URL, igga.com/6mistakes. You can pick that up, again, for free. So that's what the market has taught us or reiterated to us the last month. Let's look at historical returns. And this is, not just looking at November, but also November, December, and January. So November, historically, 1.5%. We were about there, right? We were way better than 1.5%, actually. But it was a bullish month. December, on average, 1.7%. Since the early 1900s, it's typically a very strong month. And January is typically very strong as well, 1.2%. If you think about why, you think about people's moods, right? Psychology of investors. Everybody's maybe a little bit more happy, maybe a little bit more stressed, but maybe a little bit more happy. They believe a little bit more in the market. They've got more money. They receive bonuses from their employers. They max out their 401ks. They put all this money to work, which tends to lead to a strong December and January. So historically, that's what's happened since the early 1900s as far as annual returns. That's not a guarantee that that's going to happen in the future, but that's what we're looking at. We're definitely at Iron Gate Global Advisors. We're optimistic. We like where we are. We're not saying that we're going to, have outstanding returns moving forward, because you never know, but we're confident in what we're doing and how we have portfolios positioned. So my friends, relax. We can take it from here. If you have any questions for us, feel free to reach out. There's our contact information. We would love to hear from you. Thanks, everybody.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.